Let me take a few minutes to give a background. This section was introduced from assessment year 13-14 by Finance Act 2012, mainly to curb the practices of issuing shares at a substantially higher value than the underlying assets of the business. From a certain identified quarters of the country, the shares were issued at a premium of 1 lakh or 2 lakh when there was no business in the company. And therefore the question was that whether a share premium which is received in excess of a face value of shares could be taxed in the hands of the company. Conceptually, the share premium which is received is on capital account and is not an income for the purpose of Income Tax Act. And therefore, the section 56(2)(7)(b) was introduced to tax any amount which was received in excess of the fair value of shares could be taxed as other income in the hands of the recipient company. You are aware that at the same point of time, section 68 proviso was also inserted by Finance Act 2012 from assessment year 13-14 to provide that if in case of a company, if any share capital or share premium is received, then, and if the three conditions of section 68, the genuineness, creditworthiness, and the identity of the investor is not proved, it could be taxed in the hands of the company. And in addition to that, by proviso, a source of source was also could be inquired by the assessing officer. So it was brought on the same year by the same Finance Act 2012. So one fundamental question could arise that suppose there is an infusion of a share capital at a premium of 100 rupees. The department disputes the fair value. Department disputes the creditworthiness, identity, and genuineness of a transaction. Could this amount be taxed both under section 68 and section 56(2)(7)(b) as in excess of the face value of shares? The amount will be different because under section 68, the entire amount will be taxed, whereas under section 56(2)(7)(b), it is the amount in excess of the face value of shares that would be treated as other income. But because of introduction of section 115BBE, the tax rate would be substantially different. In case of section 68, it would be 60% plus, whereas in case of 56(2)(7)(b), it would be a normal rate of taxation of a company, which could be 25 or 35, depending upon the facts. One fundamental principle all of us know, that same amount can't be taxed twice, but the objective and purpose of both the sections are different. And therefore, the one question that would arise, that whether the same amount could be taxed under section 68 at the higher rate of taxation, and also under section 56(2)(7)(b) as other income taxable at a lower rate. And that is one question which is for a deliberation. At some point of time in future, the law will have to develop and say that the same amount can't be taxed, but then whether the assessing officer would be right to tax at a higher rate and not tax under 56(2)(7)(b). The second principle, that this particular section is applicable to a company and it is not applicable to a company in which public are substantially interested. Now, company in which public are substantially interested is defined in section 2, clause 18. Interestingly, if you read the provisions of section 2, clause 18, a public company, though unlisted, but a wholly owned subsidiary of a listed entity, is also a company in which public are substantially interested. And therefore, suppose there is a listed entity and there is a wholly owned subsidiary of a listed entity subject to conditions of Section 2, Clause 18. And if there is a issue of shares at a premium in that subsidiary company, which is not a listed entity, 56(2)(7)(b) will not apply, because as per law, it is a company in which public are substantially interested. And therefore, this one analysis, particularly when it is having a relationship with some listed entity, one will have to examine from an applicability of 56(2)(7)(b). There are 2 or 3 exemptions which are given from an applicability. The first exemption is in case of a venture capital undertaking which receives money from another venture capital company or an undertaking or a specified fund. The second exemption is in relation to a startup. There is a notification issued by the CBDT on 19th February 19, 2019, where certain conditions are provided. The conditions are that the startup company cannot invest these funds into certain restricted categories. If they invest, they lose this exemption. And in that case, by virtue of Proviso 256(2)(7)(b), the provisions of fair value of shares and the demonstration that fair value is as per the method provided in the law will be applicable. But if those conditions are complied by the startup company for a period of 10 years, then this particular law on excess premium will not be applicable. And this was basically meant because in the initial period of startup, everything is on idea, everything is on certain future projections. And there it was becoming very, very difficult to demonstrate that the valuation is fair based on the numbers or the projections. And therefore the government rightly, with a view to promote the startup community and with a view to promote the angel investors, this particular exemption was given. But one will have to look at those conditions of the startup so that if you breach any of the conditions of the notification, then this exception would not apply and one will have to comply this particular provision of law. The third exception, that there are certain entities which have been notified on 24th May 2023. And under that notification, certain investment from certain foreign government or certain entities which are registered with SEBI, certain insurance or pension funds, and certain other investors from a particular specified countries. There are countries which are specified of 21 countries. Interestingly, the UAE or GCC countries, countries like Singapore, etc. are not included in the notified list. And therefore, if the investment is coming from these countries, which are not notified under this notification, then one will have to examine this valuation. And therefore, one will have to examine about the source of the country from where the money is coming. And the substance of the principle would always be relevant. Because if ultimately you is the final beneficial owner of this investment, and if those investments are coming from those countries, one will have to examine about whether it would be eligible for exemption or one will have to comply the fair value of the shares. This is what we discussed. Now, until finance up to March 23, this particular provision was applicable only to our resident investors. And therefore, if there is a non-resident investment under the FDI policy of the government, under FEMA, then 56(2)(7)(b) was not attracted. It was governed by the FEMA provisions. And therefore, as far as income tax is concerned, the investment by the non-resident was not covered under 56(2)(7)(b) or any other provisions of the Income Tax Act. But now, with Finance Act 23, effective from 1st April 23, the investment by non-resident would also get covered as far as 56(2)(7)(b) is concerned. Now, one will have to see what could be the challenge. The first challenge is that under FEMA, you are all aware that there is a threshold or a minimum pricing as per internationally accepted methodology, that if the amount is more than the minimum threshold, then it is in compliance with the FEMA. And let's take a simple example. Suppose if the fair value of the shares is 100 rupees, and if the foreign investor makes an investment of 125 rupees based on the negotiation, then it is in compliance with FEMA because it is higher than the fair value. The India is getting higher foreign exchange from the non-resident. Now, post-amendment in 56(2)(7)(b), this 25 rupees, which is higher than the prescribed fair value or a value as per the rules, this 25 would be taxable in the hands of the company. And therefore now, even for a non-resident, it will have to be only at the fair market value, which is prescribed in the rules. And it will also need to be complied with the FEMA non-debt regulations as far as the pricing methodology is concerned. And therefore, many times in our transactions, that the valuation is a floor price or a benchmark price, but the parties, the Indian company and the foreign investor, they negotiate on a higher price. And if the foreign investor agrees, then it could make investment at a higher price and a higher premium. But now, because of the income tax provision amendment, this also could be a challenge as far as the valuation is concerned. The second contraposition is vis-a-vis the Companies Act. Section 62 of the Companies Act allows issue of shares on a preferential basis at a fair value. As per rules of under the Section 62 and the share capital debenture rules, the rule says the price of the shares and other securities to be issued on a preferential basis shall not be less than the fair price determined based on a valuation report of a registered valuer. In other words, as far as Companies Act is concerned, the share price cannot be lower than the fair price. For the purpose of income tax, the fair value cannot be higher than the fair value. So it is completely contrary to each other. The FEMA provisions, which is a floor price, the Income Tax Act says you can't get premium higher than the fair value, and Companies Act says that you can't issue shares less than the fair value. So what is the result of all the three laws? You need to arrive at one golden figure, which is a fair value, if you want to meet and comply all the three provisions of the Act. So now, even if you negotiate, and your negotiation, suppose on the earlier example, your fair value was 100, you negotiated for 125, you will have to obtain the valuation report for 125, which is a fair value for Companies Act, which is a fair value for Income Tax Act, and which is a fair value even for the FEMA purpose. Because if you get report of 100 and you issue shares at 125, it would be in compliance with Companies Act and FEMA, but it will be violative of an Income Tax Act. And if you issue shares at 100, whereas the fair value is 125, it would be in non-compliance of the Companies Act, it will be a non-compliance of the FEMA. And therefore now, every investor and every company, when they do a preferential issue, also from a non-resident, they will have to arrive at one magic figure, which is the fair value. And that fair value will be based on the methodology, which we will discuss slightly later. Based on this, one will have to arrive at a magic figure. And this is one important factor as far as valuation is concerned. And about the valuer also, it would be a challenge for them to arrive at exactly one figure. Many times in practice, I have seen that valuer gives a range that you can negotiate between this range and this range. Now it cannot be a range. It has to be only one magical figure as far as the valuations are concerned. Now let me go to what is fair value. The Act says on the explanation that fair market value of the share shall be the value as may be determined in accordance with such method as may be prescribed. And we are all aware about Rule 11 UA. It also provides that if you do not follow UA, 11 UA, which is a method prescribed under the rules, but if the company is able to substantiate to the satisfaction of the assessing officer any other value based on the assets, underlying assets or intangible assets, or even a business and commercial rights, then whichever is the higher amount, that would be treated as a fair value. So suppose if, as per Rule 11 UA, the fair value is 100, but the company is able to substantiate that I have certain pharma biologics, which is a patented product, and I would be able to achieve higher amount of valuation. And if the assessing officer is satisfied, then it can issue shares at a higher value. But the question also will be again coming back on what basis company will substantiate the fair value to the income tax officer. Ultimately, it will have to be based on the valuation report. And therefore, you will need a valuation report to substantiate that the value at which the shares are being issued is at the fair value. The next question, which becomes relevant, is that Rule 11 UA prescribes two methodologies sub-rule 2. One, net asset value. Another is discounted cash flow method. The first question is that if a company has obtained a report under the DCF method, can assessing officer say, I want to replace the method to the net asset value method only because we do not trust your valuation report is not reliable for XYZ reasons. My personal view would be that it is an option given to a company to follow either of the method, including the third alternative about the company substantiating the value. And therefore, in my opinion, the officer has no right to replace or change or substitute the methodology. He can always dispute my methodology. He can always say that I do not agree to your working. I do not agree to your projections. I do not agree to a discounting rate or a market multiple. But he cannot say that you are required to follow under this particular method and you cannot issue shares at this particular under this particular method. And therefore, I would believe when we go to some judicial opinion, there one of the tribunal has taken a slightly different view. But with all respect to the honorable tribunal, I would personally believe that that should not be allowed to change the method. The assessing officer is not allowed to change the methodology as far as the valuation. If you recollect, under transfer pricing, the wordings are most appropriate method. So having regard to the transaction, having regard to availability of data, one has to apply most appropriate method. There is no such terminology here. It is only saying that as per the methods prescribed under the rules, and there it is or, and therefore I would believe that one should not be allowed to replace the method. The CBDT on 26th May 2013 has issued a draft rules as far as the valuations are concerned. And under draft rules, they have given 2 or 3 underlying principles. One, as far as non-resident is concerned, the other 5 methods are also proposed to be prescribed. The comparable company multiple method, the probability weighted expected return method, option pricing method, milestone analysis method, and the replacement cost method. The other good thing which has been done, that price at which the shares are issued to the notified entity or to a specified fund or a venture capital undertaking could be treated as the fair market value for others also. So in other words, if the amount is received from an US investor and which is a prescribed notified entity, and if the shares are issued to him at 100 rupees, and if the same price is adopted for other investors, then that would be taken as the fair market value, because that amount will be comparable to the exceptions provided in the Act. And therefore, this is one good welcome suggestion as far as the draft rules is concerned. The second, the merchant banker report cannot be older than 90 days, which in my opinion is a fair proposition, because under discounted cash flow method, beyond 90 days, the projections can undergo a change, particularly for certain specified sectors. And the third, which is again a welcome stand, is a 10% safe harbor, that if the variation is up to 10%, then no addition can be made. You are aware that under section 50, capital C, or under section 56 to 10, a 15% variation is allowed from the property price. Similarly, on the share value, up to 10% variation is acceptable range as far as the fair value is concerned. These rules are yet to be notified, but I think this is a draft rules, which is a welcome stain as far as 2 or 3 particular aspects are concerned. One interesting point, that under Rule 11 UA, Sub-Rule 1, which is applicable to transactions covered under 56 to 10, which is mainly a transfer of shares, the concept of book value and the concept of net asset value under this particular section, that is 56 to 7B, is different. When you go to Rule 1 and when you calculate the fair value of shares as per the books, it has the provision which says that as far as immovable property is concerned, you have to follow a circle rate. As far as shares and securities are concerned, you have to follow the methodology provided in these rules. As far as jewelry and certain architecture paintings are concerned, it will be an open market rate. These items are not found place as far as sub-rule 2 is concerned. Sub-rule is simple. You just add equity plus reserve divided by number of equity shares. That will be an NAV. You are not required to replace the immovable property with a circle rate. You are not required to replace shares and securities with any other methodology. You just say assets minus liabilities or equity minus plus reserve, subject to certain adjustment of income tax or provision for earned asset and liability, but which are normal. And therefore, in a simple words, it is a simple net asset value. Whereas under 56 to 10, you are required to change or replace the certain market value of certain assets like human property, shares and securities, etc., etc. Now, let me, before I go to certain valuation challenges and certain other issues, let me first take 3 principal decisions. There are more judgments on this issue, but let me take 2 or 3 principal judgments. This is a judgment of a Madras High Court, where a company had followed a DCF method and the assessing officer tried to compare the DCF method projections with the actual numbers on the projected revenue versus actual revenue of the assessing. The question was that whether the assessing officer has a right to compare the projected numbers with an actual numbers, and that whether any defect could be pointed out as far as the valuation report is concerned. The tribunal and the High Court both concurrently held that the difference between a projected revenue and the actual number was not material, it was very, very marginal, and that there was no any other flaw in the method of valuation or value of shares. And therefore, the department's appeal by the High was dismissed by the Honorable High Court, and the tribunal judgment was confirmed. The only question which, if I ask to myself, that if there was a material difference between a projected revenue and the actual revenue, could there be a difficulty as far as the valuation report is concerned? And therefore, let's go to the second judgment of a Chennai tribunal, where again the same issue arose. But the Honorable Tribunal said, one, you can't change the methodology from DCF to NAV. One. Number two, the actual amount of revenue and the projections cannot be same, because these are projections based on scientific basis, whereas actual revenues can undergo a change basis the actual transactions and the actual business. And the third important point, that the DCF method cannot be rejected just because the numbers vary unless there are defects as far as the projections and the basis is different. And therefore, this is a good judgment as far as the taxpayers are concerned, which establishes that comparison between projected and actual numbers is not correct, and assessing officer cannot change the methodology from DCF to NAV. Coincidentally, this particular judgment of a Delhi tribunal slightly takes a different view. The Honorable Tribunal says that if the DCF method is not correct, then assessing officer has a right to change the method to NAV. One. Number two, which we will discuss slightly, certain limitations of scope and caveats and certain assumptions which are given by the merchant banker, that he has relied upon the projections given by the company without actual verification. He has not independently verified the projections. He has not independently verified the assumptions. And therefore, according to the Honorable Tribunal, merchant banker has not independently applied the mind. It has only followed, or the words used are reverse engineering, that the Honorable Tribunal took a view that the merchant banker has only followed what the value company wanted, and he followed a reverse engineering without any scientific projections or scientific data for the purpose of valuation. And therefore, according to the tribunal, the DCA valuation was rejected and the entire amount was added and confirmed by the Honorable Tribunal. I am not sure about what has happened at the High Court level, but this is one judgment which is against about the change in methodology and also about certain limitations of scope with the valuer had included in his report. And therefore, one will have to be slightly careful as far as this is concerned. Let me go to certain practical challenges. The first issue about startup company we have already discussed, and therefore I will not repeat. The first bullet point, obligation of a valuer to verify assumptions. And this is the most important and a burning issue today as far as the valuation reports are concerned. I would request that under Insolvency Bankruptcy Code, IBBI had issued a circular or guidelines dated 1st September 2020, which is applicable from 1st October 20, exactly on the same issue of caveats, limitation of scopes, and obligation of the valuer as registered valuer for the purpose of valuation of shares and securities, land and building, and plant and machinery. Now, 3 or 4 important aspects one we need to keep in mind. One, it is always the management who furnishes the information. It is always the management who submits the projections. But as a valuer, it is my obligation and duty to prima facie verify those projections. It is also my duty and verify the assumptions which are taken. Like, for example, what will be the growth in the revenue? what will be the capex, what will be the estimated cash flow, what will be the number of people I will recruit, what will be my other expenses. All these assumptions and the projections that the company prepares. I have an obligation and duty to prima facie verify these. It would be very, very difficult to say as a valuer that I am not responsible for the projections and assumptions which the company has prepared. And therefore, the report and which the earlier judgment of a Delhi tribunal, which we just discussed, one could have a challenge. And I have seen in my own practice that all valuation reports which has put these caveats and scope limitations, the department has challenged this, that valuation report is not from an independent person. He has not done anything, and therefore the report is not reliable. Let me read 2 or 3 lines from the IBBI circular as far as the responsibility of the valuer. An affirmative statement that the information provided and assumption used by the management and others in developing the projections have been appropriately reviewed. Inquiries made regarding basis of key assumptions in the context of business being valued and the industry and economy. Affirmative statement on adequacy of information and the time for carrying out the valuation. The credibility of information supplied cannot be supported. The consideration should be given as to whether and how such information is being used. In other words, the IBBI suggests to a registered valuer under the Companies Act that when you value shares, so if under the Companies Act section 62, if a registered valuer is valuing the shares, he is bound to follow these guidelines issued by the IBBI. In other words, and we all know as a professionals, when we do audit of an accounts, in the first para, we say that we have relied upon the information given by the management. But at the same time, we say that we have verified this information to the extent possible. We have cross-checked the assumptions. We have cross-checked the growth of the business, the expenses, capex, cash flow, discounting rate, beta, the market multiples, the comparable companies, P/E ratio, etc., for all the valuation reports. And therefore, I would personally believe that if these particular things are not done by the valuer, and if the report is given without considering and without doing the prima facie review, the department would be it will be very easy for the department to challenge this report, and it will be difficult for the company to prove in future. Let me take a simple example. I was doing an assessment of an hospital few years back, and where the valuation report was given by some valuer. When the department challenged this, I asked the client to say that, can you give me what is the per bed rate? What will be the occupancy of the hospital? What will be the capex of this hospital? What will be the incremental addition as far as the hospital is concerned? And to my surprise, there was no such information. It was just kept the revenue that we will earn 10 crore in year 1, we will have 30 crore in year 2, we will have 100 crores in year 3, we will have 125 crores in year 5, and 150 crore in year 5. Now, what was the basis of this growth? What was the basis of occupancy? How many doctors' expenses would be there? What will be the sharing between the hospital and doctors? Which department of the medical, like cardio, like ortho, like cancer, like any other line, what will be the OPD versus IPD? If it is a cancer hospital, my per bed revenue could be higher. But if it is a normal treatment, then my per bed revenue would be less. All these assumptions and all this information was not available. Similarly, when you do a valuation of a technology company, you take a valuation of a startup company, subject to exception what we discussed, but only on the valuation. You will need to compare certain markets. You will need to compare it will be very difficult to compare a like to like, orange to orange, but at least it has to be comparable reasonably to the extent possible. And we have all learned this on comparability under transfer pricing provisions, that which company is comparable and which companies are not comparable. The similar principles I will have to take for the PE ratio, for the market multiple, for the discounting rate, etc. And therefore, my only request to all of you, that when you do a valuation of shares for the purpose of 5627B, or for the purpose of FEMA, or for the purpose of Companies Act, please ensure that assumptions are reviewed, projections are reviewed, the discounting rate, market multiple, and other information is available in the valuation report itself. Many times, the regulators say that the information is not available in the valuation report, and the report is very, very sketchy. In fact, the IBBI, these guidelines of 1st September 1920 also lays down what should be the broad contents of the valuation report, what should be the broader procedures of a valuation report, and for all the three classes of assets also lays down what could be your scope of limitations and caveats which you can include in a valuation report from a professional safety perspective, so that tomorrow you are not subject to unnecessarily harassment. And therefore, my request to all of you, please go through these IBBI guidelines, and it is a good guidance as far as what should be the scope of a valuer, what could be included in the valuation report and what could be not included in valuation report. Whether you follow a particular method, like for example, in the draft rules, now 5 methods have been prescribed. Why are you not following a particular method? If that explanation is there, it would always help the reader of the valuation report to at least demonstrate that you have examined all the methods and then ultimately you came to a particular view about the valuation methodology. The valuation standards. Institute has issued a valuation standards which are ultimately applicable and mandatory for all the professional chartered accountants, and also the chartered accountants who is a registered valuer under Companies Act also would be obliged, because the RVO has also prescribed the valuation standards of the institute. The valuation standards of the institute does give the guidance based on internationally best accepted methodology, and therefore the report should cover all the basic requirements about the scope, limitations, the methodology, the information which is collected, and on what basis you have particularly applied. We all know that valuation is an art, is a science, and therefore what we have understood from an Income Tax Act, that any information or evaluation based on a scientific data would normally be respected, and therefore if it is a scientific approach based on a proper evaluation of projections and assumptions, I would personally believe that that valuation report would be accepted, should be acceptable to the tax authority, if not at least at the high level of litigation. Comparison of projected cash flow. Again, going back by the judgment of earlier 2, I don't think this is a good comparison which every assessing officer makes. And therefore, whenever he tries to make this under 5627B, you should first object to this. Ultimately, the DCA valuation is a projection based on your estimated future growth. And if you are able to demonstrate the projections on the basis, the underlying calculations, underlying market analysis, underlying competition, underlying your business rationale, then I would believe that it should not be a difficulty as far as the comparison between actuals and the projections. And ultimately, projections are always projection, and therefore it need not be matched with actuals. And therefore, one would be able to do this, but provided what I earlier said, that your projection should be broadly on a scientific basis. The extensive research based on the information memorandum, which is exactly what I said about the underlying data, underlying basis, the market, competition, etc., etc. The capacity utilization also should be factored into. In any manufacturing industry, it cannot be 80% on day 1. it would go gradually from 50-60% to a particular level. Why 40%? Why 60%? And this why should be answered by every valuer for every projections and assumptions which are being taken for the purpose of valuation. In a retail industry, what will be the per day average footfall in the retail industry? You go to DMart, you go to Reliance Mart. Or ultimately, what is the average experience of the daily outflow, daily footfall of the people as far as the retail industry is concerned? Average daily rate in the hospitality industry, what I earlier spoke, exactly the same thing. Then, what is the directors and investors' experience? If your competition is a listed entity, or if your competition has some research report available in the market that could be referred to, the management discussion analysis on a listed entity could also be helpful as far as the understanding the business, understanding the growth, understanding the assumptions which are being taken. The force majeure clauses like Corona, like monsoon, etc., that cannot be considered. These are exceptional situations. But otherwise, the normal business cycle, normal industry cycle also should be taken into consideration as far as the projections and assumptions are concerned. As Honorable Tribunal Delhi uses the word reverse engineering, that should not be followed. That if a company insists on a particular number, and if one is trying to arrive at that particular number by hook and by crook, in my opinion, the concern of the department would be justified as far as that valuation report is concerned. The industry analysis of the management consultant, again, because of the social media, because of Professor Google and other information available in the social media, all this information is easily available, and one would be able to find out the relevant and reliable information between what is relevant to that particular valuation. And therefore, that also could be used as far as the valuation is concerned. Understanding the sector expansion, the scaling opportunities. What would be the scaling opportunities? I have seen reports where a growth, every year growth was capped on 15 to 20%, but there was no capex expenses. Now, without capex, how could I have a growth in a manufacturing sector? It was not a service sector. And therefore, certain basic things and certain basic issues needs to be considered as far as valuation is concerned. One more point. Many times on market people, I have seen that certain valuer puts that according to him, the 20% would be a good amount of market multiple. In his opinion, 10% would be a good amount of market multiple. I would personally believe that any numbers which is included in the valuation report has to have certain background to it. Why you are taking a particular 10, why you are taking a particular 20. You can always estimate. It is ultimately a valuer's expertise and valuation estimation based on the industry, based on the company, based on the projections, assumptions, everything. But ultimately, one will have to consider that the valuation for the purpose of company has to be based on certain scientific basis. Let me also take one or two examples of that IBBI circular in para 3.6. The illustrative caveats, limitation, disclaimer not to be used. One of the other issue, which is also becoming relevant, is about physical verification of assets. When you do a discounted cash flow, are you also expected to physically verify the tangible assets? I would personally value that discounted cash flow method does not recognize the physical verification of the tangible assets. But if you do a net asset value, are you expected to physically verify the assets? There is an expectation from IBBI that at least you prima facie, on a material basis, at least verify the records of the balance sheet, the fixed asset register, and other underlying records. In case of a DCF, I don't think that would be relevant because ultimately it is based on the revenue numbers, and the value of the assets, the utilization of the assets is ultimately reflected in the projections and the revenue and the profitability. And therefore, this is one a thing which one will have to deal with is as far as the valuation is concerned. And the last issue is about the acceptability by the tax department. My personal view, and I have seen in last few months, that certain officers actually appoints independent chartered accountant after taking internal approval to do a valuation of the shares based on DCF method. And then, so instead of referring to the departmental valuer, because who may or may not be competent to do a DCF valuation, he refers to an independent chartered accountant or registered valuer, and then tries to compare the valuation report, which in my opinion is a preferred way, because the valuation which is done by an initial professional compared to another professional who has been engaged by tax department, one would be able to justify the numbers, one would be able to demonstrate that what the earlier valuer has done is right, and therefore in that practice has also started, and therefore one should also be cautious that whatever valuation report one is being issued and whatever is being presented to the tax department should meet the requirement of a law and the purpose and objective of this particular law. Thank you very much. We have next 10 minutes, and therefore I would be happy to answer certain questions if anyone would have. One question, whether reference to the fact that a valuer is deriving value basis method prescribed under the law would be suitable basis for a choice of method of valuation. As I said, the law does allow a NAV or a DCF method. The DCF has to be valued by a merchant banker. As I said, the explanation to section 56(2)(7)(b) also gives an option to substantiate based on underlying assets, which could be any other methodology which is relevant. And if one is able to demonstrate with the scientific data and scientific logic, then I would believe that that method should be acceptable to the tax department. If for any reason that method is not acceptable, as I said, department cannot replace the method. It is an option given to a company to obtain the valuation report. What if there is a primary and secondary issue of shares on the same date? How can we justify the valuation difference? As I understand, the primary issue would always be a preferential issue, and therefore you will have to comply the Companies Act section 62. The secondary is again, you will have to comply section 56(2)(10), and therefore if it is the valuation based on the Companies Act on a primary issue and a preferential issue, then one would be able to follow the DCF method, and that also would be relevant as far as the secondary issue. But secondary issue, 56(2)(7)(b) may not apply. It would be 56(2)(10), where the methodology for the rules is only one method, which is the book value adjusted by a certain market value of assets. And therefore, both would be on a different footing. Whether 56(2)(7) is applicable on conversion of CCPS or CCD into equity shares? It's a good question. So answer would be yes, that conversion of a CCPS or the CCD into equity, and when you credit the premium to share premium account, 56(2)(7)(b) would be applicable. The only a slightly different perspective is that when the CCPS was issued in year 1, and there was a commercial understanding with the investor that this CCPS would be converted into a particular equity shares at a subsequent point of time, or if the CCDs were issued with a with a determined methodology for conversion into equity shares subsequently, I would personally believe that when you will have, and if the 56 to 7B is complied in year one, in the year in which it is issued, there is no need to comply again in the subsequent year of conversion. So when we will have to either comply in year one, when the CCPS or CCDs are issued at the commercial terms based on the valuation report of the relevant period, or in the year of conversion, based on the valuation report of the year of conversion. But if ultimately, because many times the commercially people agree that we will convert CCPS into particular multiple. Now that multiple and everything was decided in year one. And in year one, if I have taken a valuation report and if that demonstrates my commercial terms, then I would believe that there is no need to comply 7B in the subsequent year of conversion. So it will be either year of issue or year of conversion. But if the commercial terms are agreed upfront, then it should be year one when the shares or CCDs are issued. There is a chat about the 90 days. The report should not be older than 90 days. This is as per the draft rules issued by the CBDT for 11 UA sub-rule 2 in relation to 56(2)B. For a merchant banker report, not for a registered value report for DCF method. And this is still in a draft stage. The comments were invited by the CBDT. And as and when it gets final, the rules will be available. But this is at the draft stage and only for a merchant banker report under 11 UA sub-rule 2 and not by the registered valuer. How would the consideration be determined if it is in the form of an asset instead of a cash? It is the same thing. Ultimately, it has to be a fair value of an asset. The answer would be same whether it is in cash or it is in the form of an asset. It has to be taken as a fair value. Because when you do a valuation as per the standards, it will be a fair value of that asset based on the methodology prescribed. Though CBDT has allowed additional method like DCF for 7B, but considering the different approach in income tax FEMA for valuation can be applied for other sections like 210, can we take an argument? Also, other methods should be allowed. It could be argued, but ultimately, the law has provided only a particular methodology for 56 to 10, and therefore, it has to be followed unless the law is amended, number one. Number two, as far as FEMA is concerned, the law does not provide DCF as a specific methodology. Law only provides it should be as per internationally accepted pricing methodology. But by practice, DCF is an internationally accepted pricing methodology. But suppose if it is a pure investment company and there is no revenue, then I don't think the DCF method would be a relevant method. One will have to opt for any other method. As far as Rule 11 U and 56 to 7B is concerned, you only can have two methodology or one additional methodology by which you are able to substantiate the fair value. But FEMA does not provide the DCF as a particular methodology. If we take section 56 to 7B in the year of conversion, it will be based on the valuation report at what you convert. So if you convert 100 CCPS into 10 equity shares, you will have a valuation factor. That valuation and the amount of premium when you will have to substantiate based on the valuation report. Because your valuation report will be the basis for the purpose of conversion of the CCPS into equity or CCD into equity. The question is that can we take the other valuation method except NAV to derive EIF fund? I am not expert on EIF fund. I will have to, but my general understanding is that EIF fund valuation is provided under the SEBI rules, and therefore one will have to follow the SEBI principles as far as EIF fund valuation is concerned. But I would request to check up the SEBI rules because I am not accustomed to EIF valuation and the EIF fund valuation. What I said was that when you convert CCPS or CCD in the year of conversion, from say, for example, 100 CCPS to 10 equity shares, then on what basis you have decided the conversion factor? That basis of conversion factor would be based on the valuation report, and that valuation report will have to meet 56 to 7B principles. What should be the date of the valuation report before the draft changes in the rules? As per 56.2, I would believe that it has to be on the valuation date, except in case of an NAV. The rule 11U provides that it will be based on the balance sheet, either on the valuation date or it should be based on the last audited balance sheet. But if it is a DCF method, it should be nearer to the valuation date. Now, there is no answer to it that whether 90 days is nearer or whether 180 days is nearer. But normally, even under FEMA, the bankers normally prefer a 90 days report. And which in my opinion, since it is a projections, the economy is evolving, the business is evolving, and therefore 90 days, older report than 90 days, compared to that, within 90 days will be a preferred option. Whether a law prescribes a method for valuation or NAV in the case of transfer of shares? Yes, the law prescribes the NAV method subject to adjustment for market value as far as 56 to 10 is concerned. There is no choice of method. That is a minimum value. You can always transfer shares higher than this.